Welcome to this explainer. Today, we're decoding the economics of money and banking, and we're going to answer a very practical question. What exactly happens to your dream house's mortgage when the central bank raises interest rates? Consider this your ultimate, straightforward study guide to understanding the financial engine that runs our modern world.
Okay, let's dive right in. We're building your knowledge block by block today, moving quickly through the foundation of money, the demand for it, the money supply machine, the central bank toolkit, real-world interest rates, and finally wrapping up with macroeconomic policy.
Section 1. The foundation of money. Let's start with the absolute basics here. What actually is money, and why do we bother using it instead of just trading goods with one another? Well, money isn't just that physical cash in your wallet. By definition, it's literally any commodity that is widely accepted as payment for goods and services or to repay debts. And this brilliant invention saves us from the absolute nightmare of a barter economy. Imagine trying to trade your web design skills for a tank of gas. Economists call that logistical headache the double coincidence of wants, and money completely solves it. But to pull that off, a commodity has to serve three primary functions. First up, it has to be a medium of exchange to seamlessly facilitate those transactions. Second, it needs to act as a unit of account, which just means massively reduces the number of prices we have to track in our heads. And third, it's got to be a reliable store of value, so you can safely save your purchasing power for next year without it disappearing. And to fulfill those three functions better and faster, our payment systems are always evolving. We've shifted from lugging around heavy commodities like gold to carrying paper fiat currency, writing checks, swiping cards for electronic payments, and now we're mostly using instantaneous e-money. The whole goal across human history has just been to lower transaction costs and make exchanging things as frictionless as possible. Section 2. The demand for money. So now that we know what it is, why do you and I actually choose to hold on to it? Why not instantly spend or invest every single dime we get? There are two big historical perspectives to know here. The classical theory basically says we hold money just for everyday transactions, buying coffee, paying rent, that's it. But the Keynesian theory expands on that. Keynes argued we hold cash for three distinct reasons. Yes, the transactional motive, but also a precautionary motive for sudden emergencies and a speculative motive where we're holding cash specifically based on where we think interest rates are going in the future. And the Baumol-Tobin approach adds a really fascinating layer to this. It highlights that there's a real opportunity cost to holding cash. Think about it. If your money is just sitting in your physical wallet, it is actively missing out on earning interest in the bank. So you're constantly balancing that lost interest against the benefit of avoiding transaction costs, like the hassle of constantly running to the ATM. This means that even our basic everyday demand for pocket money is surprisingly sensitive to interest rates. Section 3. The money supply machine. Let's flip over to the supply side. What's the actual engine creating the money circulating around us? Well, the crucial takeaway here is that the money supply isn't just magically controlled by one single person pulling levers in a secret room. It's a highly dynamic team effort involving four key players. You've got the central bank, commercial depository banks, depositors like you and me, and borrowers. All four of these actors constantly interact, and their behaviors combined decide whether the money supply expands or shrinks. Section 4. The Central Bank Toolkit. Now, sitting at the top of that monetary machine is the central bank, and they have three main levers to heat up or cool down the economy. Their absolute go-to, most flexible tool is open market operations, or OMO. If the central bank wants to raise rates, here's how it goes down. Step 1, they sell government bonds to commercial banks. Step 2, those banks pay for the bonds, which instantly shrinks their available cash reserves. Step 3, because money in the banking system is now tighter and harder to come by, the interest rates for borrowing go up. Simple but incredibly powerful. While open market operations are happening all the time, they do have a couple of backup tools. They use discount lending, which means they can offer loans directly to banks at a set discount rate, usually to stop a severe financial panic in its tracks. They can also tweak reserve requirements, which is essentially the government directly dictating the exact percentage of your deposits that banks are legally forced to keep locked in their vaults, completely untouched. Section 5. Real-world interest rates. Okay, let's connect these abstract concepts straight to your personal finances. Remember the scenario from the start of this explainer? Imagine you wake up, check the news, and see the Central Bank of Kenya, the CBK, has raised its target funds rate by 0.5 percentage point. What actually happens to your wallet? How does a high-level policy move mess with the mortgage rate on your dream house? Here is the ripple effect. First, the CBK uses those open market operations we just talked about to pull cash out of the system, hitting that higher target rate. Second, commercial bank reserves immediately dry up a bit. Third, because those reserves are now scarce, banks have to charge each other way more to borrow money overnight. That interbank lending rate spikes. And finally, step 4, commercial banks are not just going to absorb that extra cost, they pass it right down to you. Suddenly, consumer lending rates jump, and the monthly payment on your new mortgage becomes noticeably more expensive. Section 6. Macroeconomic Policy Mix. Zooming way out to the macroeconomic level, we can see how these individual interest rate changes manipulate total output across an entire country. Central banks are constantly steering the ship. During a recession, they'll use expansionary policy, flooding the system with money to drop interest rates, hoping to eagerly boost private investment and get the economy moving. On the flip side, if the economy is running dangerously hot and inflation is spiking, they hit the brakes with contractionary policy. They decrease the money supply, pushing interest rates up to purposely tighten up investment and slow things down.
But there is a really fascinating wrinkle here called the crowding out effect. Sometimes a government needs to borrow heavily to fund its own spending. That massive borrowing increases the overall demand for money, which naturally pushes interest rates up. Those higher rates end up actively discouraging regular private companies from taking out loans for new projects. It's a totally unintended consequence where the government's borrowing effectively starves the private sector of cheap capital, crowding out private growth.
And as we wrap up this explainer, I want to leave you with a really provocative question pulled straight from our source material. We know that lower rates are supposed to stimulate investment, right? That's the theory. But if a central bank aggressively slashes rates all the way to zero during a deep, severe recession, why might businesses still completely refuse to invest a single dollar? Think about the psychology of business expectations. If the future looks incredibly bleak, cheap money might not be enough to fix it. Thanks for joining me today, and keep questioning how the financial world around you actually works.